Welcome to this explainer. Everyone has been literally sitting on the edge of their seats lately, just waiting for the Federal Reserve to finally cut interest rates. We were all expecting cheaper credit cards, more affordable mortgages, and honestly, just a little more breathing room in our monthly budgets. That was the master plan. But as we're about to see, the Fed just signaled that this plan might be entirely off the table for now. So today, we are doing a real, hard reality check on exactly what just happened, and more importantly, how it directly impacts your wallet.
So the huge question we really have to answer right off the bat is the rate cut dead? Because for anyone out there carrying credit card debt, just waiting for lower rates to swoop in and save the day, or anyone wondering where they should actually be parking their hard-earned savings, this explainer is exactly for you. We aren't just talking abstract macroeconomics today. We are digging into the concrete numbers that literally dictate your personal finances.
Okay, let's dive right into this. Here's our roadmap for today. First, the Fed's surprise move. Second, why inflation remains the enemy. Third, the bad news for debt. Fourth, the good news for savings. And finally, we'll wrap up with your practical action plan. Let's get to it.
Starting off with Section 1, the Fed's surprise move at their June 17th meeting. At that meeting, the Federal Reserve voted completely unanimously, 12-0, to hold interest rates steady at a target range of 3.50% to 3.75%. Now, on the surface, I totally get that sounds incredibly boring. A hold sounds like watching paint dry, right? But that headline hold actually masks a massive, fundamental shift in how the Fed is viewing your money going forward.
Because the real story was actually buried in something Wall Street likes to call the dot plot. Let's demystify this term right now, because it's actually pretty simple. The dot plot is literally just the Fed's internal projection. It's exactly where each individual Fed official thinks interest rates are headed in the future. Basically, it's how we get a sneak peek into their master plan.
And what's really wild is how drastically these internal projections just flipped. Back in March, the median expectation pointed toward one rate cut this year. Everyone was excited. But by June, reality hit hard. The dot plot flipped entirely. The median official now expects rates to actually end the year higher than where they are today. In fact, 17 out of the 18 officials now see inflation risk tilted to the upside. They literally think things are more likely to get worse before they get better.
Which brings us to Section 2, why inflation remains the enemy and why it's stubbornly sitting above that 2% target.
Look, the Fed's absolute #1 job is controlling inflation, and right now, it just isn't cooperating. On July 1st, Fed Chair Kevin Warsh made this incredibly clear in his public comments, stating flatly, inflation is still too high. The Fed's preferred inflation measure has been running well above their 2% target, and they are absolutely terrified that if they cut rates too early, they're going to reignite inflation all over again and make things vastly worse in the long run.
So the crucial thing to understand here is the specific psychological danger the Fed is sweating over right now. They specifically called out elevated energy prices. See, if energy prices stay high for too long, they risk becoming what economists call embedded in consumer expectations. Basically, if you and I go to the grocery store or the gas station and just naturally assume prices will keep rising, our behavior changes, and that belief itself creates a vicious, self-fulfilling cycle. This is exactly why the Fed is being so deliberately and honestly frustratingly cautious.
All right, let's pivot to what this means for you, starting with Section 3, the bad news for debt and our variable rate reality.
Let this staggering number really sink in for a second, 21 to 23%. That is the current average APR for credit cards actually carrying a balance right now. We are literally looking at some of the absolute highest interest levels in decades. If you have an adjustable rate mortgage, a variable rate personal loan, or credit card debt, you're completely exposed to these extreme highs.
With rates this sky high, carrying that debt feels like dragging an anvil around with your finances. And here is the harsh reality. Even if the Fed magically cut rates tomorrow, credit card companies are notoriously slow to pass that relief on to you anyway. There's always a lag. But with the Fed now holding steady or even leaning toward hiking, that relief isn't coming anytime soon. The debt sitting on your credit card today is absolutely not getting cheaper this year. Waiting around for the Fed to rescue you is a very, very dangerous game to play right now.
But hey, it's not all doom and gloom. Let's move to Section 4. The good news for savings, which is the real silver lining of this explainer.
There is a massive discrepancy right now between account types. The national average interest rate for a traditional big bank savings account is sitting at a measly 0.38%. Honestly, you might as well just stuff it under your mattress at that point. Meanwhile, high-yield savings accounts, usually from online banks, are offering meaningfully higher returns. If your money is sitting in a traditional account, you are literally leaving real, tangible cash on the table every single month. While inflation is quietly eroding the value of the cash sitting in those low-yield traditional accounts, these elevated benchmark rates actually force online banks to offer much better returns just to compete for your deposits. High rates are terrible for borrowers, for sure, but they are a genuine, massive opportunity for savers, provided you actually have your cash sitting in the right online accounts. So, what do we actually do about all this? Let's get into Section 5, your practical action plan and what to do next.
Here are 4 concrete, completely jargon-free steps you can take to protect your wallet right now. Step 1. Stop waiting for a rate cut rescue. Attack your debt aggressively, especially anything sitting over a 7 or 8% APR. Step 2. If you have variable rate debt, look into whether you can lock in a fixed rate option so you aren't exposed to any potential future hikes. Step 3. Move your idle cash out of that traditional 0.38% account and into a high-yield savings option so you can actually capture these elevated rates. And finally, Step 4. Keep building those emergency reserves. With borrowing being this incredibly expensive, having cash on hand matters more than ever, just so you aren't forced onto a 23% APR credit card in an emergency. Well, we've covered a ton of ground today, all the way from the Fed's unanimous 12-0 vote to the staggering reality of 23% credit card rates. So I want to leave you with this final provocative question. Given everything we've looked at today, are you more worried about your debt right now, or are you more focused on maximizing where your savings sit? Take a minute to think about your own concrete numbers. If this explainer helped you get a firmer grasp on what is actually happening with your money, make sure to subscribe and definitely drop a comment below with your answer to that question. I can't wait to read them, and I'll see you in the next one.